Welcome back, dear students and scholars. I hope you are doing well. In the first video, we built the foundation of ASC 270, what interim reporting means, why it exists, and why the integral view matters. Now we move from meaning to rules. This video is about annual discipline plus interim judgment. In simple words, we need to know when the same annual US GAAP rule applies exactly and when ASC 270 permits a specific interim period modification. Here is our learning path for this video. We will start with the annual US GAAP base, then move into revenue, inventory, expenses, special items, public interim data, and ASC connections. We are not doing full calculations here. That is intentional. This episode builds the rule framework first because if the rule logic is weak, examples become mechanical button pressing. Video 3 will convert these rules into numbers and illustrations. Think of annual US GAAP as the engine and ASC 270 as the control system for shorter reporting periods. The engine gives us recognition, measurement, and disclosure principles. The controls tell us how estimates, allocations, and interim disclosures work when the reporting window is only 3 months or 6 months. So, interim reporting is not a separate accounting universe. It is annual accounting principles operating under a shorter deadline. The starting point is always the annual US GAAP base. Revenue recognition, inventory measurement, expense recognition, contingencies, and accounting changes do not suddenly become casual because the period is shorter. ASC 270 allows specific interim tools, but only within defined gates. This is a very important professional point. Smoothing earnings because management dislikes quarterly volatility is not judgment. It is a reporting problem wearing a nice suit. Now let us see the integral view in action. Quarter 1 may begin with an annual estimate. Quarter 2 may revise that estimate as better information becomes available. Quarter 3 may adjust further as year-end becomes clearer, and the annual result eventually reconciles all interim periods. The logic is that each quarter is part of the full year story. The quarter matters, but it does not live alone on a deserted accounting island. Revenue is the easiest place to begin because the rule is disciplined. Interim revenue follows the same annual revenue principles. If the entity satisfies a performance obligation during the interim period, revenue belongs in that interim period. If control transfers after the reporting date, revenue waits. ASC 606 still applies fully. The 5-step model is not simplified just because the report is quarterly. Cutoff discipline is where many mistakes begin. Every interim reporting date needs year-end style cutoff. Goods shipped, services delivered, and performance obligations satisfied must be assessed against the actual transfer of control and the reporting date. The method used annually, whether point in time or over time, should remain consistent. Pulling revenue forward to rescue a weak quarter is not aggressive accounting. It is simply wrong accounting. Product cost and direct service costs generally follow annual treatment as well. Raw materials, labor, overhead, and direct service cost are matched with the related revenue in the period. The key idea is consistency with annual reporting. ASC 270 does provide certain inventory related tools, but they are specific exceptions. They are not a license to change cost methods whenever a quarter looks inconvenient. Inventory creates several interim reporting challenges. A physical count may not be practical at every interim date, so ASC 270 permits estimation methods such as the gross profit method when appropriate. But there is a price for using estimation. The method must be disclosed, and later physical counts may require adjustment. The exam trap is to think estimation means approximation without discipline. It does not. The LIFO liquidation rule is a classic ASC 270 issue. Under last in, first out inventory accounting, an old low cost layer may be temporarily liquidated during an interim period. If that layer is expected to be replaced by year end, interim cost of sales should reflect the expected replacement cost effect. The point is to avoid showing an artificial interim profit boost from a temporary inventory movement that will not remain at year end. Inventory declines also need careful judgment. If a decline in value is temporary and recovery is reasonably expected before year end, interim recognition may not be required. But if recovery is not expected, the loss is recognized in the interim period and cannot be pushed to a later quarter. If the same inventory later recovers, the recovery is recognized only up to the earlier loss. No extra gain is created beyond the prior write down. Standard cost systems bring another layer of interim judgment. Purchase price, wage rate, and usage variances are normally reported in the same way as year end. But planned price or capacity variances may be deferred if there is a reasonable expectation that they will be absorbed by year end. Notice the word reasonable. The standard is not asking whether we want the variance to disappear. It is asking whether the evidence supports absorption. For other costs, the default rule is simple: recognize as incurred. Administrative, selling, and general costs are not automatically spread across quarters. Allocation becomes appropriate only when a cost clearly benefits more than one interim period. So the first question is not, can we smooth this? The first question is, what period receives the benefit? That question keeps the accountant honest and the financial statements meaningful. When allocation is justified, the basis must be reasonable. Time expired may work for insurance or licenses. Benefit received may work when the service or output is uneven across periods. Activity level may work when costs follow production, hours, or revenue. The method should also be consistent with year-end reporting. A new basis every quarter is not sophistication, it is a warning sign. Annual volume effects are a good example of the integral view. Customer rebates, quantity discounts, and annual sales targets often depend on full year activity, not one quarter alone. Each interim period recognizes its proportionate share based on interim sales compared with estimated annual sales. If the full year estimate changes, the cumulative adjustment is recognized when the estimate changes. This is why one quarter cannot be separated from the annual commitment. Prepaid and accrued costs follow the same principle. Property taxes may be allocated over the year. Advertising costs may be deferred when the future benefit is specific and measurable. Major repairs may be assigned across benefited periods when the obligation and benefit patterns support that treatment. But convenience is not enough. The link to future periods must be direct, supportable, and consistent with the annual reporting approach. Seasonality is not an accounting error, but it can create user misunderstanding. A holiday retailer, an agricultural business, or a weather dependent company may show sharp swings across quarters. Temporary supply chain issues or one time demand surges can also distort a period. ASC 270 requires disclosure of material seasonal variations, so users do not read one quarter as if it represents the whole year. Unusual or infrequent items are treated differently from seasonal patterns. A material unusual event, infrequent event, or disposal of a component is reported in the interim period in which it occurs. It is not spread across the full fiscal year to make the income statement look smoother. This is a practical exam trap. Seasonality may need explanation, but special items are not blended into normal results simply for comfort. Contingencies begin with annual contingency principles, especially ASC 450. A loss contingency is accrued only when loss is probable and reasonably estimable. If the loss is reasonably possible, disclosure may be required. After that annual analysis, ASC 270 asks whether the contingency relates directly to prior interim periods of the same fiscal year. If it does, those interim periods may need adjustment when the amount becomes estimable and material. Accounting changes and errors connect strongly with ASC 250. A change in accounting principle generally follows retrospective application when required. A change in estimate is handled in the period of change and prospectively. A change in reporting entity may require restating prior interim periods. An error correction is not hidden inside current results. The big memory point is classification first, treatment second. Public reporting adds another layer. Public companies file Form 10Q with the Securities and Exchange Commission. These reports contain condensed, unaudited interim financial statements, not a full annual style package. The condensed balance sheet, income statement, cash flow information, and selected notes focus on current quarter and year-to-date information, plus significant changes since the annual report. Condensed does not mean optional. Required items still matter. Let us close with the ASC Connection Map. ASC 270 touches ASC 220 for income statement effects, ASC 250 for changes and errors, ASC 330 for inventory, ASC 740 for interim income taxes, ASC 275 for risk and uncertainty disclosures, and ASC 280 for segment information. If this helped you, please like the video, share it with your colleagues, subscribe to Commerce Regiment, and support the channel. In the next episode, we turn these rules into original examples and illustrations.